All right. Good morning, everybody. My favorite part of the day is to get the Daily Huddle started. I feel like this big producer getting us started. Thank you all for being here. My name is Giovanni Gonzalez, and I'm the co-host of the Daily Huddle. The Daily Huddle is a conversation Monday to Friday at 9 in the morning Eastern time to give us some powerful context to start our day, to give us context for the rest of the day, and to give us a context for the rest of our lives. You know, there's a saying that the way you start your day gives you your day, and the day that you live, the way that you live each day gives you the rest of your life, right? The Daily Huddle is here to empower you and to give you a view on how to make better decisions and make better choices. And it is a real pleasure for me to co-host the Daily Huddle with my friend, mentor, and business partner, Mr. Sorel J. Qatar. To me and to many, he is the #1 executive coach expert in the planet. Thank you, Sorel, for being here.
Good morning, Giovanni, and good morning, world. A special good morning to each of you in the virtual studio audience that is live on Zoom. Welcome this morning. This is episode 28 of Your Huddle. And to those of you watching us on Facebook or on YouTube, welcome to another edition of the Huddle. We exist indeed that way. And I give thanks and I'm grateful for my business partner, Giovanni Gonzalez, the #1 transformational leadership coach, and my partner. I'm grateful for that. And I've got the great honor to introduce today someone who's become a friend. And I say that because in business, when you network, I've had this idea that you network and you do business with people, and that's, if you're not networking with them, then maybe they're not your friends anymore. But I've had the pleasure for the better part of 9 months now to meet every Tuesday morning at 7 a.m. with a group of trusted professionals whom I'm counting on maybe for the rest of my life as those people who are the kinds of resources that when a friend, a professional, or anyone comes up to me and says, Sorel, I need X, I'm able to go into my bevy of lists and go, I've got X for you, and X is resident in this person. And by virtue of being that close to such individuals, I have the privilege to actually have that. And if somebody ever asks me going forward, if I've got an expert in the world of mortgages, the person I would come to and point them to is Victor Nassar. Victor's our guest today. Victor's been in the business for 15 years. Now, what makes Victor the professional I love is not the fact that he knows a whole bunch about mortgage business, and he does, right? Mm-hmm. What makes Victor special is that he is there to ensure that every single client, every single individual, whether they're paying him or not, end up making the best decision possible when it comes to their mortgage, and that they start to see their mortgage as this integral part of what their financial picture looks like. So today's question is, how does your mortgage fit in your overall financial plan? Right. And Victor Nassar is the man to address that question. Victor, welcome. Thank you so much for being here.
Thank you, Sorel. Appreciate it. Thank you for having me this morning. I'm going to share my screen here. Let me see if I can figure this out.
All right, go for it.
Can everyone see that?
Yes, we can.
Okay. So I've been in the mortgage business for quite a while, and I've been on the wholesale side of the business, which was the customers were my banks. Customers were banks. Now I'm on the retail side for the last 12 years, and my customers are the direct consumer looking to finance their home or to purchase a home. I worked with financial planners as referral sources. I work with CPAs, past clients, and also as well as real estate agents. But I look at the mortgage from a different prospect because it's the biggest asset you'll own typically. in time, and it's the biggest payment you have every month on a cash flow basis. So my question to everyone is, how does that mortgage fit into your overall financial plan and everything you do on a day-to-day basis? So when I'm talking to a client, some of the questions that pop up: why are you buying your home? Are you tired of paying rent? Are you getting married and you no longer want to have two payments? Did you just sell your current house? Or maybe your parents just said it was a good idea. I have a lot of millennial clients. They go, it's time to move out of the house. Maybe you want to build up your real estate portfolio, or you finally just want to own your own home and have that asset you've been longing for, what we call the American dream. So when you look at all that in the marketplace, it can be very confusing. What are your mortgage choices in the marketplace? You've got a conventional mortgage, which is what we call Fannie Mae and Freddie Mac. Then you've got an FHA loan. You have USDA financing, which is out in the rural territory. VA financing for our veterans. And of course, we've got jumbo loans, which are loan limits over $510,400. And there's many different types of homes you can look at. A lot of clients I help, obviously those that are looking to purchase their primary residence or to refinance their primary residence. People that want to buy a second home. We are licensed in the state of Florida. I've got clients that want to buy investment properties on a regular basis. And are you buying a single family residence, a townhome, or maybe even a condo? I'm in Georgia. Co-ops aren't very popular in Georgia, but they are very popular in the Northeast. And let's look at all the down payment requirements. On the previous slide, you saw the down payment requirements on a Fannie Mae loan can go as low as 3%, FHA 3.5%. But when you're looking at second homes or investment properties, the game changes a little bit. On a second home, you need at least 10% down payment. And on investment properties, the ideal down payment is 25%. But after that, we take a look at what is the best term of mortgage for you. Typically, everybody wants to default to a 30-year mortgage. This gives you the lowest payment and helps with your cash flow on a daily basis. So we're going to look at the options that you have and the other questions that I ask my clients. What are your other monthly financial obligations that affect your choices in a mortgage payment? Do you have car payments? Do you have credit card debt? Do you have student loans? And keep in mind, if you want a lower payment, the 30-year mortgage is the place to go. But also, it's going to be, if you shorten the term of the mortgage, more of that payment goes to principal, but you do have a higher payment. But it does pay off much more quickly. So I have a lot of clients asking me, Victor, what are the differences between a 30-year mortgage, a 20-year mortgage, and a 15-year mortgage? So we're going to go through some opportunities here and some case studies to talk about what I did with a few of my clients. We have a mortgage example recently for one of my clients for a $270,000 refinance. It's 80% loan to value. So the house appraisal was approximately $335,000. We looked at different options for her. We looked at a 30-year fixed rate, a 25-year, a 20-year. We looked at a 15-year and also a 10-year fixed rate mortgage. So when you look at the 30-year, the 25, and the 20, you see that the interest rate's about the same. The financial markets price these products at about the same price. But look at your difference in payment. $1,175 on a 30-year. But if you take 5 years off that loan, your payment's only going to go up approximately $150. On a 20-year, your payment's not quite jumping $400. In a 15-year, the benefit of the 15-year, you're getting the lower interest rate and you're cutting many years off your mortgage. But that payment jumps up dramatically. A lot of people cannot handle the 15-year on a cash flow basis, but it is an option to take into consideration. And of course, you have a 10-year fixed rate, which is going to be the highest payment out there. When I'm speaking with clients, one of the most common questions I get is that, can I avoid PMI or private mortgage insurance? When you don't put 20% down, you will have PMI. It's just a necessity. And PMI is based on a couple of different things: how much equity you have or how much you're putting down on the purchase transaction, and also what is your credit score. These are the two factors that affect the private mortgage insurance premiums. The higher your credit score, the lower your private mortgage insurance premium. Private mortgage insurance is not a bad thing. It allows the buyer to purchase more home with less down payment, and it also protects the lender in case there's a default on the loan. So it's a double-edged sword, but it's really very beneficial. I'm going to look at some case studies when I've recently helped some clients, and these are in the last couple of weeks. And these are clients I've been working for off and on for 4 or 5 years, but now they're buying another home. I have a couple in their early 50s selling their current home, walking away with approximately $100,000 in equity. They have $70,000 in outstanding debt between car loans, credit cards, and personal loans. They have a current house payment of approximately $2,900 on a 30-year mortgage. They make good income, they're comfortable with the current house payment, but they're also investing their money. They're maxing out their 401k and they're having other investments. Their initial thought was to put down 20% on a purchase on a 30-year mortgage, and they came to me. So we had the conversation in their 50s of what they want to do and when do they want to retire. If you take into consideration all the debt, I proposed that we don't put 20% down on the mortgage. We put 5% down, but we literally take the proceeds of the house they're selling and pay off all their current debt. The houses, the car, the credit cards, and the personal loans they had outstanding. When we do this, we still had 5% left for a down payment. I improved their cash flow by $1,700 a month, and they're very comfortable with a payment of approximately $3,100. When we took a look at this, they said it's something they never took into consideration. So when I speak with a client, we have to take that overall picture of where does that mortgage fit in their financial plan. It's going to be different for somebody in their 20s or 30s versus somebody in their 50s in this situation. In this particular situation, they're now looking at a home, they're about to go under contract, and they want to do a 15-year mortgage, and they're going to pay off their debt. Case study number 2 happened just last week. I have a school teacher in her early 40s, recently divorced. She has a retirement plan, plus assets that she has invested from the proceeds of a divorce. She purchased her home 3 years ago at a rate of 4.5%. She called me as a referral and asked me for a 30-year mortgage because she wants to save $200 or $300 a month for her cash flow. She's got one daughter, and she goes, if I can save $200 or $300, I can invest it and save money. Her payment was approximately $1,600 or $1,700 a month. On her new appraisal, the appraisal came in well enough that we eliminated the private mortgage insurance she had 3 years ago. And in addition to the new rate, we saved her more money. When we looked at the comparison of a 30-year versus a 20-year mortgage, her payment was about the same. So she says, I can go to a 20-year mortgage, I proposed, take 7 years of interest off the loan, and her payment only increases $25 a month. So she's not getting that monthly cash flow benefit that she wanted of $200 to $300, but if she pays her house off in 7 years, she's taken that entire asset that she wants, she will sell the house and take the proceeds and move to the beach. This was a strategy I proposed to her and something she never thought about. So when I sit down with a client, and I encourage everyone, how does that mortgage fit into your overall financial plan? Please take that into consideration. Thank you.
Victor,
Any questions?
that is awesome, Victor. Thank you so much. Now, I know many of you watching live on YouTube and Facebook, and many of you here are either homeowners looking for transition, or you don't own a home yet, and you're wondering, how does a mortgage fit in your overall financial picture? And today we've got Victor here to answer your questions and help you think through the different scenarios that might be appropriate for you. So Giovanni, anything you want to add before we open it up for questions?
I think that, one of the things that I was maybe is useful for me to add, or maybe to create the opportunity of questions. I remember thinking many years ago that mortgage was a very complicated thing. And also that it didn't, for many years, I didn't see it as a plan for me in my future. It was just a payment I had,
Right,
that I had to deal with, right? And also, I didn't know that the wrong decision, right? The wrong decision can impact me forever. For it's a huge financial impact, and interest rate is a huge financial impact. Refinancing is a huge financial impact, right? And
Right.
not kind of getting a real sense on when to do it, when to avoid it, right? Not to be quick at taking money out of the escrow account. Things like that are just so critical to have a friend in that side of the world, right? So I just want to kind of to add that, and if anyone on the studio audio has a question, that would be really, really powerful to get an answer, given that we're really creating a conversation where you get to have your questions answered in the most authentic way, and looking at all possible options. I wonder if anyone on the studio has any questions. Lori Kay has a question.
Go ahead, Lori Kay.
Yeah, I own my own business. Well, two questions. One is, do you do mortgages in Georgia or just in Florida?
we're licensed in Georgia and in Florida. I live in Atlanta.
Okay. And my other question is, I have my own business, and it's a lot harder to show income, especially currently I'm a photographer, so I'm not able to work right now. Well, I'm doing some work, but it's certainly much smaller, and I was not able to work for a while.
Right.
So the question is, what would be some advice for those of us who are kind of laid off now, but would, being able to refi or, have a smaller mortgage? What would be some things that we need to prepare for, or some advice that we might have moving forward?
Sure, Lori Kay. The market's quite interesting right now. It's very unprecedented, unlike 2008 and 2012 during the recession. I work with a lot of self-employed borrowers, and typically your Fannie Mae guidelines say we need 2 years of income to show. We have to show that trend. Up until recently, just in the last 6 weeks with COVID-19, there were bank statement programs for business owners, which means if you show the deposits over 12 months, they had a formula to calculate income. So if you took your 12 or 24 months bank statements, you added up all the deposits, they took away a 50% expense factor. So let's say you had deposits of 100,000, they took away 50,000 for expenses, then they took the rest of the 50,000 and they divided it by 12 for an income. So that's one of the programs they had out there for self-employed people if they couldn't show their tax returns and you couldn't use a Fannie Mae or Freddie Mac loan. Now, unfortunately, right now, those programs have gone, but we think they'll come back when the market stabilizes again. But always plan in advance if you're self-employed, where are you going to be for 2 years, and think ahead when you're trying to buy a house. Much different than a wage earner.
One of the things that came up when I called, I have a Bank of America, which is also, what is it, Freddie Mac? Fannie Mae. And they would not, Bank of America would not add it to the end of my mortgage. They would only, so the 3-month forbearance comes and I have to pay the 3 months. And even though I argued with him that that's not the way that it says.
That's correct.
That go to the, at this point it's already started, so I'm not sure what to do. But they said when this is all over that Fannie Mae has it on their website that however long it takes for this to get over, then they'll do this to put it to, I guess there's a whole bunch of different options to do.
the COVID-19 crisis has had the lenders come up with a solution to go into forbearance. There's a couple of problems with that. They're going to tell you they're going to tack it onto the back of the loan, but all of a sudden, after this crisis is over, they're going to want you to pay a lump sum of all those mortgages up front. So it's very, very deceiving. Then when you go into refinance, if you come to somebody like myself, they're going to go, hold it. You've been in forbearance. I'm not quite sure we can refinance you now. So the messages are very, very mixed, and we're still trying to work through that. If you have the means to make your mortgage payment, even if it's only the interest only portion, talk to your banks to see what can they do without putting you in forbearance, because that forbearance is going to affect your ability to refinance down the road. We might get a break on that. They may come out with additional guidelines, but for now, it's very confusing.
So what do I do now that I've already started the forbearance program?
Ask them, what can you do? Is it still been recorded? And we're at a loss of words too. We're getting the same messages from Fannie, from Freddie, all the big banks that we work for that buy our mortgages. I don't think anyone has an answer right now. So we're have to wait and see what happens. So my apologies on the mixed messages from the industry, but I think this all happened so quickly, the banks didn't know what to do.
Thanks. I appreciate it.
Go ahead, Mary Pat, and then Marie Fertoni, you on deck.
Well, I just want to say thank you, Victor. This was so clear. And my husband and I are in this space right now in our 70s of refinance and so forth. And I will have him call you because you are so clear. Thank you so much for this morning. It was great.
Thanks for having me. Appreciate it.
Marie Fertoni, go ahead and unmute. It's your turn.
Okay. Thank you. Thanks, Sorrel. Good morning, everybody. Thanks, Victor. I just have a question that's in general. I work with a lot of entrepreneurs and coach a lot of entrepreneurs, and a common question always comes up it's more like a common pain in the butt that comes up, is that when the government gives us this power to be an entrepreneur, they give us tax benefits, all these kinds of things, and they give us legal deductions, which can actually minimize your tax liability.
Right.
But yet when we go to apply to a mortgage, and we've had different people come and speak to our organization, there seems to be like this double-edged sword that makes it, you almost have to not take all your deductions legally to show that you make more income, then qualify for the mortgage, then go back and edit your tax return so that you can really get the tax benefit. So it's like, you know, any advice that you have to people that work really hard, they deserve a mortgage. I mean, this is like a conversation that's in my community big time, and no one seems to really address it.
It's a very common problem. As you stated, it's a double-edged sword. You take the tax deductions, then it affects your ability to get a mortgage because you're not showing the income.
Right.
I've worked with some CPAs that send me referrals, and we look at it this way. Are you paying yourself as a self-entrepreneur W-2 as well as a K-1 on your return? So you've got two sources of income. What if you paid yourself as a W-2, but your K-1 income's a little bit lower? So for a couple of years, bump up the W-2 income.
You have to be an S Corp for that though, right?
Yes, you have to chat with your CPA about that. But you look at, take your W-2 income and then reduce your K-1 income. So
What's
when you look at
K1?
that, it's your distribution income from ownership of the company. So your CPA can explain that. But the second thing I mentioned earlier in the conversation with Laura Kay is there were bank statement programs out there specifically for business owners and people who couldn't share their tax returns. Those programs aren't around today. Literally, they've disappeared in the last 30 days, but they're available in the near future. I think they'll come back. Did I lose everyone?
No.
Okay.
Now you're there. I was going to say, you know, I remember when I got my first mortgage in 1986, I was single, self-employed, and a woman. And I had to be a crazy person in order to get the bank to look at me. So I chose, really, seriously, I chose to be a crazy person. And then I got my mortgage. They just shut me up and I didn't really care because I got my mortgage.
Right.
Here's the thing though, that I would like maybe as a mortgage professional, if the mortgage industry can do more to influence the conversation for the business owners, because
Right.
so many people suffer from that and are paying, way too much for a rent than, they could have easily for a homeowner, and then start to build their equity and their value. And that's a new conversation to bring into our culture.
It's definitely a market that needs to be addressed. We've been speaking about this for 4 or 5 years on my side of the business.
Yeah,
Is
thank
Wall
you.
Street going to come up with an idea for self-employed people that they can actually get a conventional mortgage at a fair rate, 3.5%, 4%, and not 6 or 7% like these bank statement programs. But it's a needed market, and hopefully something will come up in the future.
Thank you. Thanks so much for listening.
Thank you, Marie. And Adriana, you have your hand up. Go ahead.
Thank you. Good morning. My question is simple. The PMI is an element very common in all mortgages, almost. How anybody who doesn't have any knowledge about loans is able to review if they can take the PMI off and then lower the payment, the monthly payment.
Okay.
It's something that is promised to us that the bank will take off after 5, 10 years, depending on the bank.
Right.
But they never do. So how we can be proactive and see if we can take the PMI from our loans.
By law, Adriana, your mortgage insurance is supposed to fall off once your loan hits 78% loan to value. In my presentation, I had 80% loan to value because it was a refinance and it was a new appraisal. So we used the 80% loan to value. But if you're in your current mortgage and you've been in your current mortgage for 7 or 8 years, take a look at the current value of your house and call up your lender. If you like your interest rate and there's not a need to refinance, call up your lender and say, the value of my home is such. I think my mortgage insurance should be eliminated. They may send out their own appraiser. It wouldn't hurt for you to get comparables in your neighborhood and give them a call, and they should be able to drop off your mortgage insurance if that guideline is at 78% loan to value. So for an example, if you bought a home for $100,000 7 years ago, and that value is now $78,000 or less, you're at 78% loan to value. Does that make sense?
Yes, and I'm actually a real estate agent. I asked the question because many of us don't know the answer. Thank you.
You're welcome.
Awesome. Awesome. Who else?
If I may, Victor, will you please tell us what is the minimum age for anybody to purchase a home?
I want to say that age is 18 years of age. So, but don't quote me on that because you have to be considered an adult. So I want to say it's 18 years of age.
It is. It's just that many people don't know that, and it's important to create future for our children.
It is. I'm dealing with a lot of young people, and a lot of the young people are consultants in the internet business. You know, my business partner did a loan for a young man who consults with gaming, and he does all his business in gaming. And it's interesting, these people are making great incomes, and they're very, very young, but all their business is typically coming from the internet.
Victor, can you give us your contact information in the chat area?
Yes, I sure can. I'll do that.
Great job, thank you.
And if I may, another question. You didn't speak about reverse mortgages. And we are all here like kind of mature in our second infancy. How the reverse mortgage is advisable for some people and for some not?
Reverse mortgages can be very complicated and difficult to understand. First thing to know about reverse mortgages is that they have a formula that they work with. Depending on how much equity you have in your home, they have a formula of what you can get out of the home to eliminate your payment. But always keep in mind You're still responsible for the property taxes, the homeowner's insurance, and also the homeowners association. So, you know, when you sit down and do a reverse mortgage, is it a good idea? It's not a bad idea. You know, your reverse mortgages are backed by HUD, the Department of Housing and Urban Development, which also the mortgages that do FHA. So when you do a reverse mortgage, it has mortgage insurance on it. So even if your loan is, if you own your home outright and you want to do a reverse mortgage, the fees in the mortgage are going to include mortgage insurance, something very important to understand. Okay.
Thank you.
Awesome. Well, we are at the hour. Or the
One last question, Sorrel.
Ronald, you have a question?
Yeah.
Yeah, go ahead.
Hey, thank you, Victor. This is great. And I was paying attention throughout the whole thing. This is the first time I truly understand PMI. Thank you so very much.
You're quite welcome.
I've been doing some reading on insurance. Which insurance is considered a good collateral for loan for home? I mean, as the mortgage broker consultant, do you take insurance as a collateral for home purchasing?
Let me clarify, Ron, what you're asking. Are you talking about homeowners insurance? Are you talking about in case you pass away, you want the insurance policy to pay off the house, or in case you get injured?
Correct. The second, what you said, the second.
You know, I can refer you to an insurance broker. We have a great insurance guy that works with that. And these policies, you'll get emails and you'll get statements in the mail from your current mortgage lender offering you a mortgage protection plan. That's what they're calling it. And they'll take that mortgage protection plan and say, hey, in case you pass away or in case you're injured, your house will be paid off and you can leave that house paid in full to your spouse. The programs are out there. You can talk with an insurance professional and we can look into that for you and send you a few referrals.
Got it.
Awesome. Awesome. One last one, Victor. It appears Nancy may have sent you a question via chat.
Okay.
Do you have a message?
Where's, let's see, I see it. I don't see the, let me see. I don't see the question, Nancy. When did you send it, Nancy?
It's
Okay, I got it. If you buy a family home, is that yours?
yeah, and also where mortgage rates are going. I don't know if I missed that.
Okay. If you buy a family home, which was owned for 32 years, it is a private family mortgage. Do you think that the title insurance is necessary? Why and why not? The title insurance is going to protect you in case there's any issues with surveys, liens against the house, things of that nature. Is the home owned free and clear? Nancy?
Yes, it is
Okay, or are you buying it from a family member?
an estate.
You're buying it from the estate. When you speak with it, are you going to get a mortgage on it?
It's a private mortgage.
Okay. A private mortgage meaning a mortgage from a family member.
Yeah.
Okay. Is there going to be any attorneys involved?
Yes, at the closing.
Okay. So when you go to the closing attorney, and it's going to be a private mortgage, not a bank mortgage, the bank will typically require lender's title insurance. Unless the bank, in your case, the family member wants to be the bank, doesn't want title insurance, that's their discretion. Now, if you feel the property is fine, free and clear, and there's no survey issues, no encumbrances, no liens that are uncovered, then go ahead and not get title insurance. But what that does, the title insurance is protect you for the life that you own that house in case any issue pops up, liens, any encumbrance, survey problems, etc. So you can always speak with an attorney, a real estate mortgage attorney, or real estate attorney to get more information if you'd like.
And where do you think mortgage rates are going if someone wants to refinance now?
The old adage of a bird in the hand's worth two in the bush. Interest rates are very, very low. We've been spoiled. 30-year fixed rate money, 3.25%, 15-year fixed rate money, 2.875%, give or take on any day. So money is still very cheap. To put that in perspective, the bank's federal funds rate is 0. So that gives your prime lending rate at 3.25%. Your prime rate is your credit cards, your equity lines, things of that nature. So you can get a 30-year fixed rate at 3.25%, given your credit score, certain credit scores apply, and it's the same rate as the bank's lending money at 3.25. So money is very, very cheap. You should try to take advantage of it.
And do you think, how much do you think the bank or mortgage company should be taking to refinance that?
And what do you mean taking?
Charging.
Well, there's a list of charges. So the charges are attorney's fees, state tax stamps, and it's typically dependent on the loan amount. So when you look at the loan amount, you have a percentage broken down for the true closing cost versus whether or not you have an escrow account and have to set aside money for your taxes and your insurance. On a refinance, you should be between 1% and 2%, I would think, depending on the size of the loan. If your loan is smaller, your fees are going to be disproportionately higher because some fees are fixed, like your attorney fees and your title insurance. So you don't want to compare, you want to be sure you compare apples to apples, but understand that the size of the mortgage on 100,000 might be disproportionate percentage-wise than a loan at 300,000 because there's certain fees that have to be taken into consideration.
Okay.
All right.
Awesome. Everyone who participated, thank you. Victor, thank you so much for being so thorough, so clear, so kind. And, you know, there's this love for your clients and love for people that comes through your speaking. And I'm so honored to have you on the Daily Huddle. Thank you for making today valuable for all of us.
Thank you very much. Thanks for having me, Sorrel. I appreciate it. Have
All
a good
right.
week, everyone.
All right, Gil.
Thank you.
Bye-bye.
Thank you.